Okay, welcome to another video. And for regular viewers, you'll probably notice that the sound is a little bit different today, and that's because I have a new microphone. So hopefully that'll solve that issue of sound quality. There've been a couple of mentions about that, so it should be good. It is a Microsoft headset which has been optimized for Skype, and I can say that it works very well for Skype. Not necessarily a tech head as such, but I'm very pleased with this purchase, so let's get on with it. Anyway, look, what we're going to be doing is going through this report from a few weeks ago, and the purpose of this video really is to give a feel for what kind of material gets covered in the report, and to walk through one of the insights in particular. So the way the report's structured is that there's 5 different ideas, and you can see there global cycle stats, commodities, Australian credit spreads, global equity profit margins, asset market valuations. Very interesting topic, that one. But today we're going to be looking at global equities profit margins. So we did do a little write-up on one of the charts on this one in See It Market. But so here it is. Now, again, there's a key thing in the format here. So you've got a little bit of context and commentary around it, which is basically tying together the story behind the charts. And this report really is intensely chart focused. I often say if you can't tell the story with charts, then there probably isn't really that much of a story to tell. So the second thing to note is this bottom line point, and the bottom line is just a way of distilling the whole story into one line. And so for this one, it's after the micro-recession in 2016, global equity fundamentals are looking much better. And it's really worth honing in on that little word there called micro-recession, a bit of a term that I've coined here to describe what went on and where we are now in the cycle. Because if you want to understand the outlook, you have to understand where we're coming from, number one, and where we are currently. And that's why I often say I would rather base my outlook on what I see rather than what I want to see. And that means that I'm not going to be trying to get headlines on the news by making wild forecasts, saying that the market's going to drop 70% or something silly like that. What I'm going to be doing is saying, here's where things are tracking, and when we look at history, we can make certain we can make sort of conclusions about that, extrapolations. It basically gives you a factual basis to ground your conclusions and analysis in. And we've got an airplane noise. Hopefully that noise will be buffered a little bit. It's supposed to be a noise cancelling microphone, but if not, bear with us. Alright, so micro-recession. First of all, a little note on the methodology here. So what we're doing here is looking at profit margin trends. So these are profit margins from the Thomson Reuters WorldScope database. And these are for the Thomson Reuters data stream indexes. So these are total market indexes. And I've got, collated the data together for 40 different countries. And what we're doing here is a bit of a high-level sort of meta-analysis kind of thing to get the overall trend across global equities. And so the chart to the left here is taking a sort of a statistical high-level description of the sample. So we've got the lower quartile, upper quartile, and median. And you can see there the sort of the dispersion, not only the trend across the median, which sort of gives you the overall high-level view of what's going on in global equities, across countries, but then by taking a look at the upper lower quartiles, then it can give you sort of a feel for the distribution of it as well. So if there's something that's going on in the upper quartile versus the lower quartile, that can have a bit of extra information in it as well. And by the same token, if you see even the lower quartile starting to recover, that can be quite interesting as well. But anyway, focusing in on that black line, and as I like to do often, or most of the time actually, with indicators, is to set them alongside something which is useful to do so. And in this case, it's global equities, and that is the MSCI All Countries World Index, and it's in local currency terms. And as you can see there, the path or the course and level of profit margins across countries tends to correlate pretty well with what's going on in the market. Probably the exception would be this sort of last 5 years period here, where you've had that kind of stagnant relative to the pre-crisis period, but actually kind of in line with where it was in the previous cycle. You might actually argue that in that pre-crisis period it was overstated by the credit boom and the commodities boom in emerging markets. And anyway, the thing that I really wanted to highlight and hone in on is this little mini recession or micro recession that we had here. And actually, if you look at the way that it dipped down, it's actually quite in many ways on par with some of the previous downturns that we've seen. So in the early 90s, that little blip down, which was driven by commodities, the Russian crisis, etc., prior to the dot-com peak, and then at the bottom of the market in the early 2000s, during that recession there. And but it wasn't as deep, obviously, as during the wake of the financial crisis. But whenever you do go into a recession like that period there, what it can often do is act as a bit of a reset moment. And so if you thought we were late cycle around here, there was some evidence. There's probably more evidence for late cycle now than back then. But what it kind of means is that we've sort of reverted back in the cycle towards sort of mid-cycle point, and coming out of a mini recession, it's not unusual at all to see very strong stock market performance. So it's not necessarily given that that the strong run that we've had there is out of place, or that's not appropriate, or that it's gone too far. Certainly, you look at that, it's backed by fundamentals. And so that's probably really the key conclusion of this video, is that the strong rally that we've seen in global equities has been driven by genuinely by fundamentals. And a stronger profit margin means that you need less marginal sales growth to actually generate more earnings growth. And so that's probably a key positive, I guess. It's not really a useful indicator in terms of providing a heads up for a downturn, except perhaps to the extent that when it does start to fall, maybe that's something to keep an eye on. But it's probably more so a confirming indicator, coming out of a market bottom. And I guess if it does get particularly stretched, that's another sign that maybe towards late cycle. Anyway, just before closing off, we'll just show you two other charts. Now these ones are taking basically the exact same approach here, but we're looking instead also at interest charge coverage and return on equity. So return on equity is probably the purest form of profitability analysis that you can get for equity markets, because it's basically what the shareholder is seeing as their return. And you can see there that actually during this mini recession, for a number of reasons, the dip down there was very much quite a serious dip down actually. And and again, this goes back to that comment about how it essentially is providing a bit of a reset moment. Of course, the key will be to see how well it does recover. And this recovery here is lining up very much with what we've been seeing on a broader global economic front, which has been one of recovery and strengthening. Now on this one here, it's interest charge coverage. It's basically how well the company, how well the group of companies in this case are able to cover their interest costs. And you can see here that it sort of looks to be a bit of an upward trend overall. I mean, there's definitely a cycle around it. You know, if you go into a mini recession, that hits your earnings, and you know, if your interest cost is constant, then of course that's going to make it look significantly worse, and you know, vice versa. You'd probably expect to see an uptrend in this because, you know, at the same time we've seen a downtrend in interest rates. So, you know, even if companies didn't borrow any extra money, their interest cost is going to be falling. So, you know, I guess the pessimistic take would be that it's being overstated. You know, the positive parts of this chart are being overstated by low interest rates. You know, the realist or the optimist would probably say something that, like, you know, this is how, you know, lower rates are supposed to work. It's supposed to be supportive for corporates, but either way, you know, it is something that's a fact for now. I mean, my view, for what it's worth, is that interest rates, bond yields do tend to go up from here. We probably have seen the bottom, so you know, if profitability earnings do roll over, you know, after a period of rising rates, then that would damage that. But for now, it's sort of holding up at you know, interest coverage, charge coverage is holding up at decent levels, really across the board. But you know, in a general sense for global equities. So, you know, thinking about fundamentals, the picture's looking fairly good at this point. You know, based on this set of charts and analysis. So, you know, coming back to that bottom line, after the micro recession in 2016, global equity fundamentals are looking much better. So yeah, any questions, comments, please do put them in the comment section of the YouTube video below, and please also do go ahead and subscribe to the channel. You know, be looking to do at least one video per week, and you know, if you like this video, then you probably like the other videos that we've already done and the ones that we'll do in the future. And of course, if you wanted to check out this report in a little bit more detail, or any of our other reports, please get in touch. I'll put a link in the description.